Most traders lose not because they're wrong, but because they enter at the wrong price at the wrong time with no confirmation. In this video, I'll show you a strategy that fixes all three, so you stop getting trapped and start entering like the institutions do. What you'll learn in this video: how institutional algorithms actually work, the smart money cycle, the sweep and flip protocol strategy, the institutional entry formula, the institutional fair value tool, how to buy from discounts and sell from premiums. By the end of this video, you will know when smart money enters the market, how to spot high probability setups in under 30 minutes, how to enter with precision timing and confidence. These strategies are built for the 15-minute time frame. They work on all markets: Forex, crypto, stocks, futures, and commodities. If this sounds valuable to you, give the video a like, drop a comment with your thoughts, and subscribe for more smart money strategies every week. Let's get into it. Let's start with the first piece of the puzzle: how institutional algorithms actually work. Big institutions don't trade like you and me. They use powerful algorithms that scan the market for one thing: liquidity. Liquidity is just a fancy word for stop losses and pending orders. Most retail traders place stops below support or above resistance, and that's exactly where smart money is watching. When there's enough liquidity in one area, the algorithm triggers a fast move, a fake breakout or a spike, just enough to hit all those stops. Those stop losses turn into market orders, giving institutions the perfect entry with no slippage. But they're not selling the breakout. They're using that spike to enter in the opposite direction. That's why right after the sweep, the market often reverses hard. Retail traders are left confused while smart money is already in the trade. That's how the game works. The market moves to grab liquidity, not to follow your setup. If you don't understand that, you're not trading. You're being used for entries. For these algorithms to work the way institutions want, the market needs to be set up just right. And that's where the three-phase playbook comes in. This is the accumulation phase. The market moves sideways, nothing exciting, just noise. But behind the scenes, it's loading. Retail traders place stop losses below the range. Others get aggressive and place buy stops above it. Slowly, liquidity builds on both sides. Perfect fuel for the trap. Then comes the manipulation phase. A sharp spike, clean and aggressive, breaks out of the range and triggers stop losses. Traders think it's the breakout. Some enter late, others get stopped out. But it's not the real move. It's the trap. With liquidity now taken, institutions enter in the opposite direction, with full size and precision. This is the money move. The clean, directional trend that leaves retail behind. While most are stuck in confusion or revenge trades, smart money is already in, riding the wave they created. This cycle repeats every week, sometimes every day, and once you know what to look for, you'll start seeing it everywhere. Now that you understand how institutions trap retail traders, let's flip the script and trade like smart money. The strategy you're about to learn is called the sweep and flip protocol. It's designed to catch the real move that comes after the fake one, right when smart money steps in and retail traders get left behind. But to trade it properly, timing and structure are everything. We don't trade this setup all day. It's only valid during a specific window, at the end of the Asian session and the start of the London session, right when liquidity spikes and traps are triggered. You'll need one simple, free indicator to highlight the sessions on your chart. No clutter, just clear visibility. The strategy runs on the 15-minute chart. That's where we find the setup and execute the trade. But we always check the 1-hour chart first for smart money direction. A quick top-down view to stay aligned with the real trend. Let's break it down. As you can see here, this is the Asian session, and this is the London session. We'll use a free indicator to mark both sessions on the chart. Our job starts at the end of the Asian session. That's when we mark the most recent high and most recent low. This forms the accumulation phase. Then we wait for the London session to open, and that's when things get interesting. Right before the real move begins, a liquidity sweep is likely to occur. This is where institutional algorithms go hunting, scanning for stop losses and pending orders stacked above recent highs and below recent lows. And that's exactly what we're looking for too. Look at what happened. The market breaks the most recent high, sweeps the liquidity, then reverses and drops back below the level. This is classic institutional behavior, a trap engineered to fake out retail traders before flipping the direction. You'll find this setup frequently in the market, but it works best when it happens during the London session, as institutional algorithms often try to trap retail traders before making the real move up or down. And when you spot it, here's what to do. Sell at the close of the reversal candle, place your stop loss just above the sweep, target the most recent low. This is your bearish sweep and flip protocol setup. Now let's look at the bullish version. Again, this is the end of the Asian session. We mark the recent high and low. These levels form what's known as the accumulation phase. For algorithms, these aren't just levels, they're liquidity zones, loaded with stop losses and limit orders, and that's what smart money hunts. Here's what usually happens. Price breaks below the recent low, grabs liquidity, then reverses and closes back above the level. That's your entry. Buy at the close of the candle that flips back above. Stop loss just below the sweep, and target the next major level. It's a sniper entry, timed perfectly with smart money. This is the execution play, but it's only part of the plan. Next, I'll show you how to do a quick top-down analysis to filter these setups, so you're not just trading any sweep, you're trading with directional bias and precision. Now, let me show you a real chart example using the Australian dollar against the Canadian dollar 15-minute chart. First things first, let's set up our session indicator on TradingView. Go to the Indicators tab at the top of the screen, click the icon, then in the search bar, type Sessions. The one we're using is called Sessions by JRFX Addict. Go ahead and click that. Now, depending on your background color, you might not see the sessions clearly. If your chart has a black background like mine, let's fix that. Hover over the indicator name at the top of your chart, click the Settings icon, then go to the Style tab. Here's what I recommend. Uncheck New York Session to remove extra shading and keep your chart clean. Change the Asian session color to red, change the London session color to green, and that's it. Now you can clearly see where the Asian session ends and where the London session begins on your chart. Alright, now let's break down the strategy. This is the end of the Asian session and the London session opens in the next 15 minutes at 8 o'clock AM London time. We start by marking the most recent high and low of the Asian range. Watch what happens once London opens. The market pushes below the recent low, sweeping liquidity, then quickly reverses and closes back above the level. That's a clear liquidity sweep. Exactly how institutional algorithms operate during the London session. They trap retail traders with a fake move, then take the real direction, the one they were planning all along. But now that you understand the game, you know exactly what to look for and how to respond. Before we take the trade, we always start with a top-down analysis. This strategy is executed on the 15-minute chart, but we use the 1-hour chart to confirm the trend. So let's jump to the hourly and remove the session indicator to get a clear view. As you can see, the market is in an uptrend, and price recently pulled back to a former resistance level that's now acting as support. And a strong bullish candle forms, signaling a possible continuation of the uptrend. So on the 1-hour chart, we're bullish, and that aligns perfectly with our 15-minute setup. Now back to the 15-minute chart. We enter at the close of the candle that flipped back above the recent low. Place our stop loss just below the sweep and set our target at the next major resistance level, always aiming for at least a 2-to-1 reward to risk ratio. And look what happened next. The market moved cleanly to the target just as expected. Let's move to another example using the US dollar against the Swiss franc 15-minute chart. First, we mark the most recent high and low of the Asian session. That gives us our accumulation phase, the zone where retail orders are building up. Now, let's see what happens when London opens. As you can see, price spikes above the recent high, then immediately closes strongly back below it. This is a textbook liquidity sweep, a false breakout designed to trigger stop losses before the real move begins. This strong spike, that's not the institutional move, that's the trap, the liquidity grab. The real move starts after the sweep, once the market flips. But before we take the trade, let's do a quick top-down check to make sure we're in alignment. On the hourly chart, you'll notice the market is in a range. Price recently rejected a key resistance level and is heading lower toward a major demand zone. That means there's still room for price to drop, which supports our short idea on the 15-minute chart. So let's switch back to the 15-minute and set up the trade. Entry goes at the close of the bearish candle that closed back below the recent high. Stop loss just above the recent high. Target is the next major support level. This setup offers at least a 2-to-1 reward to risk ratio, exactly what we're looking for. And look at what happened next. The market moved straight to our target, just as expected. The second day trading strategy is what I call the institutional entry formula. It's built on 3 powerful pillars: fair value, timing trigger, and confirmation. This strategy is designed for the 15-minute time frame, and it works across all markets: Forex, crypto, and stocks. For this strategy, we'll use one powerful indicator, the VWAP. VWAP stands for Volume Weighted Average Price, but here's what it really means for you. It shows the true average price of the day based on volume, not just price. It resets every single day at market open. So you're not trading yesterday's story, you're reading today's reality. When price is below VWAP, you're in discount territory. Smart money is watching. Some are buying. When price is above VWAP, you're in premium territory. Institutions start looking to sell or take profit. Before we deep dive into the strategy, let me show you exactly how to set up the VWAP indicator so you can follow along with me on your charts. First, open up a chart on TradingView. Now head to the top and click on Indicators. In the search bar, type VWAP, short for Volume Weighted Average Price. Click on the first result that pops up. You'll see something like this added to your chart. A blue line in the middle, that's your VWAP, and green bands above and below it. These bands create a channel, but for this strategy, we only need one thing, the VWAP line itself. So here's how to clean it up. Hover over the indicator name at the top of your chart. Click the middle gear icon, that's the settings. Go to the Style tab. Now uncheck the boxes for upper band, lower band, bands fill. Next, to make the VWAP stand out clearly, increase the thickness of the VWAP line. You can also change the color to something bold, like bright blue or white, so it's easy to see at all times. And that's it. Now your chart is clean, your VWAP is clear, and you're ready to read fair value like the institutions do. Let's dive into the strategy. The first part of our strategy is all about using the VWAP as dynamic support and resistance. Let me show you exactly how it works. Look at this chart. Right now, the market is trading below the VWAP line. That tells you one thing: the market is cheap. But here's the mistake most traders make. They try to sell here just because it looks like price is dropping. Big mistake. When you sell below VWAP, you're selling in a discounted zone. And that's where smart money is looking to buy, not sell. You'll likely get stopped out. Because the VWAP acts as the fair value of the market. It's where institutions decide whether price is overvalued or undervalued. So instead of rushing in, you wait for price to pull back to the VWAP to retest fair value. Now watch what happens next. Price climbs back up, touches the VWAP, and then gets rejected. That's not random. That's smart money stepping in, seeing fair value as the perfect place to sell. Look what happens right after. Exactly as expected, the market drops hard. This is the strategy. This is the foundation of trading with institutions, buying at discounts, selling at premiums, using VWAP as your real-time guide. Now look at another example. This time, the market is trading above the VWAP. When price stays consistently above the VWAP, that tells you one thing: the market is in an uptrend. And now, the VWAP becomes something even more powerful. It's not just fair value, it's your dynamic support level. But here's where most traders mess up. They see the green candles flying, they panic, and they jump in at the top. That's emotional trading. That's retail behavior. And that's exactly how smart money makes its profits. Because if you look closely, you'll see the market is overbought, far away from its true value, which is the VWAP line. Now here's what institutions do instead. They wait. They let price pull back to the VWAP, right back to fair value. Look at what happened next. Price touches the VWAP, rejects it cleanly, and that's your signal. That rejection is smart money stepping in. They're buying from value, not from hype. And you? Now you're thinking like them. This is your entry point, not because the market feels bullish, but because you're buying at a fair price. Now watch this. The market moves up, just like it should, because now you're no longer chasing, you're positioning like a professional. This is how we use the VWAP to buy from fair value zones. But let me be real with you. that's not enough, because fair value alone doesn't guarantee a win. Sometimes the market fakes it. Sometimes it keeps going the other way. Let me show you a real chart example. This is the British pound, Japanese yen, on the 15-minute time frame. Now watch closely. As you can see, the market was trading below the VWAP, which means price was in a discounted zone. At this point, it's cheap, a perfect opportunity for institutions to step in and buy the dip. Now watch what happens. The market pulls back to the VWAP, which we know is the fair value of the day. And right at that level, something important happens. A volatility candle forms. It has long wicks on both sides, a small real body, and it closes right near the VWAP. Let's break this down from an institutional perspective. This candle tells you there was a liquidity grab. Institutions pushed price above the VWAP to trigger buy stops from retail traders chasing the move. Then they snapped it back down, grabbing liquidity from both sides. It's a trap, and a classic sign that smart money just took control. This is your confirmation. Now, here's how you trade it. Entry, at the close of the volatility candle. Stop loss, just above the upper wick where the trap was sprung. Target, the next key level. And as you can see, the market drops hard from that level. Let's go even deeper into confirmation signals, because when institutions want to reverse the market, they don't shout, they trap. This is what I call the engulfing trap. And in this example, we're going to look at a bearish setup. Watch this closely. The market pulls back to the VWAP. That's your fair value zone. Retail traders are thinking, price is bullish, let's buy the breakout. And right there, you get a big bullish candle. But then, a bearish engulfing candle slams straight through it. Here's how you trade it. Entry, at the close of the engulfing candle. Stop loss, just above the wick of the engulfed candle. Target, the next support or liquidity level below. As you can see, once the trap is set, the market does exactly what smart money wanted. It reverses hard, leaving late buyers stuck. This was a bearish example, but the exact same logic applies in reverse for a bullish engulfing trap. Just flip the direction. There are still more institutional signals we'll cover later in the practical examples, so make sure you keep watching until the end. Now, let's move to the next component of this strategy, the timing trigger, which in my opinion is the most important part of the entire strategy. If you find the perfect setup at fair value with all the right confirmations, if you trade it at the wrong time, you're still at the mercy of a slow or false market. So here's how we fix that. We're going to use our famous indicator, the same one we used in the first strategy, called sessions. This tool shows you exactly when the Asian session ends and when the London session begins. Why does that matter? Because this moment, the transition from Asia to London, is when volume explodes. Liquidity enters the market and smart money begins making moves. Now look at this chart. This shaded area right here, that's the end of the Asian session. And this vertical line, that's the London Open. This is your timing window. You're not staring at your screen all day, you're focused. You show up before London opens, spend 1 to 2 hours at your chart, and wait for a setup to form right inside this window. When it does, your chances of success skyrocket, because now you have timing plus price plus confirmation working together. Okay, now look at this chart example. This is the US dollar/Canadian dollar on the 15-minute time frame. And just like I mentioned earlier, this strategy works best during a specific time window, so I highly recommend you stick to it. Here we're looking at the end of the Asian session and the start of the London session. The market was already trending up, trading well above the VWAP line, which means price was overextended and far from its fair value. Then we get a pullback right into the VWAP zone, bringing price back to fair value. And this is where something important happens. A deceptive candle forms. At first, it looks like price is breaking down. Liquidity is grabbed below VWAP, triggering stop losses from early buyers and trapping sellers who think the trend is reversing. But the candle closes strong, right back above VWAP, revealing the real story. Institutions use that dip to fill their buy orders. That deceptive candle is your confirmation, not because of the shape, but because of where it formed and what happened right before it. Now, check the hourly time frame to confirm trend direction. If price is trending up, it supports your trade idea. Then go back to the 15-minute. Place the trade. Enter at the close of the deceptive candle, set your stop loss, and target the next resistance or structural level. Now here's the key. You didn't need to wait all day. This setup triggered right at the London Open. Sometimes you will need to wait at least 1 hour during the London session, but if you scan a few major pairs during this session, you'll often find one solid opportunity in the first 30 minutes. But I don't recommend taking more than 2 trades per day. One quality setup is enough if it follows the plan. Now look at another example. This is the British pound US dollar on the 15-minute chart. As you can see, during the Asian session, the market was already trending up, but price was getting overextended, trading far above the VWAP line, which represents fair value. Then, during the London session, the market continues pushing higher until it finally pulls back, right into the VWAP zone. Now watch what happens next. As soon as price touches the VWAP, it gets rejected and prints a clean rejection candle. This is your confirmation. That rejection candle tells us one thing. Institutions are seeing what we're seeing. Price has returned to fair value and it's a perfect area to buy. But before you jump in, you always verify. Switch to the hourly chart to confirm that the market structure supports your idea. If the trend is still bullish, you're good to go. Now, back on the 15-minute chart, you can place your entry at the close of the rejection candles, stop loss just below the wick, target the next major level. Now look at what happened next. As expected, the market respected the VWAP, respected the rejection, and moved straight into the targeted direction. This is how you combine logic with precision. Price, timing, and institutional behavior all lining up to give you the edge. Now look at another chart example. This is the Euro US dollar on the 15-minute chart. During the Asian session, the market was clearly trending down, and price was trading far below the VWAP, meaning it was in discount territory. Then, at the open of the London session, the market starts pulling back toward VWAP, right back to fair value. Now watch this. As price reaches the VWAP, it gets rejected. But this time it forms a clear, engulfing trap. This candle wipes out the previous bullish candle, traps breakout buyers, and signals a high probability sell trade. And look at the timing. This opportunity appeared just 45 minutes after the London Open. You didn't need to stare at your screen all day. You just showed up with a plan and waited for price to return to value. Now let's break it down. Check the hourly time frame. If it confirms the downtrend, you've got full alignment. Then go back to the 15-minute chart. Enter at the close of the second candle in the engulfing trap. Place your stop loss above the trap wick. Target the next key level or support zone. Now look at what happened next. The market moved exactly as expected because everything lined up. Fair value, timing, confirmation, and logic. Alright, that wraps up the strategy. If that brought you value, go ahead and give it a like, drop a comment if you've got questions or thoughts, and subscribe if you want more breakdowns like this delivered with clarity. No fluff. Thanks for watching, and I'll see you in the next one.